Welcome. Welcome to Market Thursday. It's January the 27th, 8 p.m. here in London. We are 1 hour away from the market close in the US. Quickly, as usual, I just want to remind you that this webinar is not investment advice, so this is purely for information. So please do your own research. I do not take responsibility for losses incurred by the viewers. So please, again, do your own research. Quickly, looking through my background, I started to work in the industry in 2000 as a cash equity trader. I worked in Paris for 4 years. Then I arrived in London from 2004 onwards. I worked first for a hedge fund here in London, where we had between 2 and 3 billion assets under management. I work on the long only product, on the long short product. So I did a bit of everything, from small, mid to big caps. Then in 2009, I started prop trading from 2009 to 2018, working for Infinity Capital Market, which is the UK subsidiary of First New York in the US, in New York. Where I had been running an absolute return mandate with no asset and returns constraints. So literally all about making money. From 2014 onwards, I've been doing mentoring, so helping retail traders from all over the world, trying to get better and getting an investment processed. Before, I used to work from 2014 to 2017 for another company called ITPM that I left in 2017. I stopped trading in 2018. So naturally, some people came to me and say, look, Greg, can you help me doing the mentoring? So I did that. We started doing mentoring in 2018, launched the 4x4 video series in 2019. And we started at Infinity 12 months ago. I wanted to have a book again and be more active. So I'm trying to do a bit of everything, being in the market, helping retail traders, and that fits my style. So today, what are we going to be covering? So far the profile of this webinar is going to be very similar to last year. I'm really thinking about changing the profile. But today, as usual, we're going to be doing the situation across asset classes, stocks, credit, commodities, and FX, looking at the recent performances, then looking at the Fed meeting that we had yesterday, talking about the stocks sell-off, equity really coming down year to date, risk off across the market. Then looking at what is the performances for the equity market on the midterm election year, and plus the seasonality that we had normally in Q1. And then, because we are literally in the middle of the earnings season, talking about earnings, because, in the long run, if you want the market to go up or down, this is mostly about the earnings. Clearly, this market has been brutal. We are down 10% year to date. I mean, very brutal. So it's literally a hit and run market where we have 150, 200 points intraday swings on the S&P. So that is very significant. We are talking 3 to 4% swing every day. So that is big. Same with the Nasdaq. So the positioning was not great at the start of the year for many hedge funds. If you look at the rumors of many performances, feels like, many hedge funds are down 10% plus. So we have been coming down, straight down. So really hit and run market, hard if you get a big growth exposure, easier if obviously you are a trader. So this is a trader market. When you get VIX around 30% or plus, or even 25%, you need to be very agile and very flexible. So in terms of catalysts going forward, as we're going to be discussing, we had the Fed yesterday, we got the ECB next week. Feels very much to me like if the Fed is so keen on reducing the balance sheet and increasing rates in the near future, that the ECB will have to do something as well. So very often the ECB is following the Fed. So that's something to check. I'm just checking, can you still hear me? Just because I'm checking that if my connection is fine. Can you just tell me if, yes, okay. Because my Bloomberg was a bit off as well. ECB next week, but literally what matters now is the earnings season. So the earnings season so far, the price action has been pretty bad, as we're going to see later. Tonight, we're going to have Apple after the close. So in an hour time, it's going to be interesting to see how those big tech stocks are going to be reacting. And so mostly about earnings in terms of market structure. In other words, what are the flows? The flows, so you get the end of the month flows that could come as the equities have been absolutely murdered. There is some flows. I read JP Morgan saying that there is something like 70 billion that could come into the market, but that's not enough to balance the outflows and the sell-off that we've seen from the CTA funds, that we have seen as well from the gamma. So if you look at the timing of what has been happening, the market, something that we discussed before, started to go short gamma. And as we are short gamma, that means, you know, the market makers need to be selling more and more futures, and it carries on and it moves and down and down and down. So you go from 4750 to 4600. Then it carries on at 4,500. Roughly, you get 4 sellers from the CTAs, which move from being long to neutral. And then you have the retail traders as well, which have been pretty long the market, who start to sell. So what has been interesting from this week, so we had the expiry of options last Friday. And as you know, now, if you've been watching some of the Market Thursdays webinar, that very often this is a big catalyst for the rebalancing or the resettling of positions. So on Monday morning, in the US, as you have many retail traders that were long some calls, long dated calls, let's say on Microsoft, on Apple, on Amazon, suddenly instead of having long the premium, they receive the shares. And as they are receiving the shares, it's too big in their account. So what happens is in the first 3 hours of the Monday morning, you get a quick sell in the market. So literally this catalyst of around this expiry, this OPEX, there is always a pickup in volatility, or very often a pickup in volatility. What is interesting is, for one of the first time for quite some time, actually, now the market is short gamma. Usually we are always long gamma, so that means we're going up and up and up, and it doesn't matter, we go up because everyone needs to catch up with this gamma. Whereas now, literally the positioning, the gamma is at, I think, 45.50 or 48.80. So we are way off. So to reset this gamma could take some time. Monday could have been a reversal, but despite the volume and everything, it feels like when you have such a reversal or such a big move like we had on Monday between the morning and the close, where literally we had a 3.5 to 4% intraday reversal, very often later the market will retest those lows. So I would not be surprised to see those 4,200 on the S&P being tested again. So that means again, the implied volatility, realized volatility, there's a chance that it's going to stay high for longer than usual. Quickly looking, if you have questions, don't be shy, ask me questions. I think it's what I would love to have is a more interactive webinars in the future, because I think only me talking is nice, but it could be a bit boring for everyone, and for me included. So asset classes performances year to date. So the picture, so this is that was taken an hour ago, no, 3 hours ago. So there is a bit of a change since then, but overall equity market in the US are down roughly between 8 to 12%. So pretty big. If you look at history, this is probably the worst January on tape. As we discussed during the ID generation for 2022, there was potentially emerging market outperforming developed market, which is happening. So emerging market is not that down, helped by Brazil and helped by China mostly. So China has been holding better than developed market. But overall, the picture is equity market are selling off. And so far, Europe is outperforming the US. For the currency with the dollar mostly again versus most currencies, so the dollar has been strengthening. So the first move, and I thought that the move will be much higher, if you look versus the euro, was down for the dollar. So we did some break and then it came back, and now we are testing very important level on the euro dollar. That's something that we're going to discuss in the technical analysis. So very strong and important level. Bitcoin is like any risk off, really suffering. So what is interesting from the crypto world is very, very similar to the growth. High sales, no PE, no earnings, no whatever that we had since October, November. All those things have been down 50 to 60%. And Bitcoin is down 20% on the year. At the right hand of the spectrum, we get WTI now at around $87, $88, based on different factors that we explained before, and we explained in 22 in the 22 webinar, which is you don't have that much inventories, stocks. You have low capex over the last few months, and demand is a bit picking up. So, and the positioning for many market participants, which are calling for the 100. So if you look at the options monitor of the positioning for WTI for June, there is a huge open interest at 100. So check those things, and as we're going to be seeing later, that means XLE is doing fine. For the USD, so there's a question for Martin. Will the USD index move and stay over 100, and why, with all that dollar printed last 2 years? So on the DXY, we're going to be looking at the technical analysis later. So DXY is 55-60% euro dollar. So that means you need to be looking at euro dollar. There has been a lot of printing in the US, but there has been a lot of printing in any country in the world. So if we look at currencies, we need not only to be looking in terms of absolute term, but in terms of relative terms. And if you think that the US have been printing, that is true as well for the Eurozone, that is true as well for Japan. So almost any central bank in the world has been doing quantitative easing and having very low rates. So I think what is happening now is the Fed has decided to be much active in fighting the inflation, but you know, if they are raising rates by 4 or 5 times this year, between 1 to 1.5% this year, you can make sure that the ECB will do something. So I think there will be a catch up very quickly from the euro. I mean, this is what I'm betting on. But you know, as always, this is about risk management, and if you get an idea wrong, that you limit your downside. So this is the week to date picture. Why we're using this one? Because I'm always using different time frame for the newcomers here tonight, and for the people who are watching later on YouTube. And as well, that gives you what has been happening since the Fed has been talking. Again, there is tons of volatility now. The S&P right now is at 4,300. It was 3 hours ago 100 points higher, meaning 2.5% higher. So it moves a lot, but the picture is really on the way down. So far is every day, or most of the recent week, we have been trying to go higher, and then we get a sell-off. So market is really weak, playing downside, and as long as you don't have this washout, there is a chance that we might go lower. let me close this thing from asset classes performances. Now looking at the sectors, so this is quite interesting to see that the only winner is energy. So energy very strong, up 20% on the month, which goes hand in hand with WTI being very strong. So name like ZOM and in Europe, all the majors have been doing pretty well. If you look at the technical of or the XLE, so making new highs. Oil today, WTI was a bit not on the edge, that would be a bit too much, but there might have been some kind of intraday reversal. So that's something to check. Other end of the spectrum, technology, consumer discretionary destroy. So everything has been really weak. So here you get the S&P, which is your proxy. So you can see that overall, very weak market across sectors with an outlier, which is energy. If we go into the next screen, looking at thing that the bonds, so here we get the bond market, looking at the year to date, how the 10 years in the US, so that's for the US Treasury, this is for the Gilt, this is for the Bund and for the BTP, roughly to give you an idea. The yields have been going higher, meaning bonds have been sold off between 15 and 30 bips. So the US 10 years is around 1.8%. So getting closer to the 2%. But what is interesting from the bond markets, actually yesterday we had a big move in the 2 years. So the 2 years moved quite a lot. So there is some flattening of the yield curve, very big moves, again, bond market. The VIX, so the gauge factor of the equity market, so very not very high level, I don't know how to say it, but 30% is a pretty high level. We started the year 17%. Again, if you don't know the rule of the 16%, you should use it. So that means it's going to be a 1% move. So 30%, that means you're expecting 2% move roughly. So, and if you look actually at the implied volatility versus the realized volatility is pretty significant these days. Look at a day like today, again, I'm repeating myself, but we get 150, 160 points intraday move on the S&P futures. So big realized volatility, telling you that there is stress in the market. Obviously, you knew it already, but it's not only through options, it's as well the realized volatility. And another thing that I want to mention is if you look at the S&P, if you are trading the futures, if you look at the market depth, the liquidity is very poor. Okay, so if you look at the first 5 bids and the first 5 asks, there is not that much liquidity. So I read somewhere that the liquidity on the future market is very much the same as it was in March 2020, meaning that the market makers are giving you a quite wide bid offer. So be careful in terms of again, gross exposure. Don't do too much small and mid, because if you need to sell those positions, that's going to be hard. Even if you retail, because liquidity is poor. Same thing with the industry's performances. So that is just to give you an idea for the newcomers and for the ones who have been following me for quite some time. Where is the money? So the S&P in blue here, year to date, so minus 8%, and we got sectors that have been struggling a bit more, like social media, consumer discretionary, and on the other end of the spectrum, again, this is mostly about energy. So energy doing very well. So if you think about the market as we start the year, I think it's nice to restart the process again and to refresh the process, should I say. You start from the top, S&P or NASDAQ, you go from the sectors, 11 sectors of the S&P, and then you go from the industries, and that gives you a full picture and understanding of what is the feel of the market, what is the should I say the market breadth. Next, I think we should go into technical analysis. Technical analysis. So we start with the VIX. So VIX 31%. So normally most of the spikes will be around the expiry. Okay, so very often when we had the spike last year, that was when we had the third Friday of the month. If you look at history, again, VIX is normally on average at 19%. So if you're reading anyone that is quoting you the VIX moving from 20 to 25 and it's going up by 25%, that doesn't mean anything. The VIX is already a percentage. So anyone that is 50,000 followers and is telling you that the VIX is moving by X%, it's just someone who doesn't understand a thing about volatility and what the VIX represents. But what you can see is there are spikes in the VIX. As always, with stress in the market, it's very, very, very hard to call the bottom. So going short volatility in cases like this is a tough one. What you should be probably monitoring is not only the implied volatility, but how is the realized volatility? Because sometimes, you know, there is a gap between the two. At the moment, realized volatility is still very, very high. So it's not only people that are protecting themselves for the end of the world, let's say by buying put. So Friday, we saw tons of put bought on the S&P, like literally tons and tons of them. But as well that the realized, meaning the real conditions right now is that we have higher volatility than usual. So the VIX, so next one is the NASDAQ, looking at the NASDAQ. So it's a bit of I don't want to do a Van Gogh and doing some art in here, but you get this trend that was broken. Okay, so I think I tweeted 10 days ago that this trend was broken. You can be using Fibonacci or not using Fibonacci because Fibonacci works sometimes it doesn't work. You know, if you are looking for support, you know, this one, is it such a strong support? It's probably not. It's gonna be challenged. The market has a tendency to push things more than we would like to. So and we got earnings season for the tech. Okay, so NASDAQ not great. SPX, should I do E-mini futures? So E-mini futures, same. You get the trend that started in November, very strong trend. We have been challenging it, and now we are at an important level around the 42.50. So we bounce on the 42.50. With the 42.50, as I said, because you get this big candle, which was done in very significant volume, which is a big positive, I think the market will challenge it again, unfortunately. No, unfortunately, depending where you're positioned. But literally the 41.50 to 42.50 is an important level. If we go lower, then, you know, it's gonna be, it really could be ugly. So let's see how we react over this next 100 points from 43.10 that we are here on the future. Up to the 4,200. One that is really not looking good, which is the Russell 2000. So the Russell 2000, everything has been broken. So the support that was being tested the whole year in 2021. So in 2021, we traded between the 2100 and this literally 2350 has been broken. And if you look at the longer term chart, it feels very much like, you know, there is potentially 300 points, like something like 15% on the downside. So Russell 2000 mean, you know, smaller caps, mid caps, bit of a crap, and crabs that's been on the way up, you know, those GME, the AMC of this world. But this picture is not that great, and obviously to recover to the 2100 is 10% from here. So that's quite a challenge. So technically, this one is probably the worst. Going into the sectors, looking at an interesting, and I'm just want to be doing some stuff that I think I see something interesting is metals and mining, XME. So trading in a range. you don't need to be a genius. You know, trade the price. If it breaks, you go with it. If you want to go through options, that's might be a good thing as well, looking at the implied volatility and playing it. Another play so they came with a number, Intel today, feels very much like we're going to be testing, going a bit lower to the 45 level. So if you look at this chart, and why I'm talking about Intel is because, you know, it's the earnings season. Let me do a logarithmic. So the logarithmic chart is really telling support, and now good chance that we're going to go into this 43 level. Tonight, what do we have? We got Apple. So Apple, so looking back and doing a regular chart, it has to come back quickly above this 165. Otherwise, you know, I feel like it's going to go to 145 quickly. So big day tonight for Apple. So far, earnings have been destroyed, the stocks. So we'll see how it goes. XLP, again, support 73. So we're close to the level. So what try to identify is going through those stocks and sectors or industry and finding some levels, some support, so that's for JP Morgan. I think the JP Morgan chart is very interesting. So tested the very important level of 140. So we broke this 146, then 140. So you see, technically there are some signals. Problem is you have on the S&P a 4 to 7%, 2 to 3 range, which is probably 2/3 of the stop losses that you should have. So in other words, reduce exposure. You don't need to be a superhero. Cash is a position as well. If you've been in the market and already short in the market, well done to you. And otherwise, you know, maybe not the best time to be the bravest person on earth. I just want to mention quickly, because this is important, the US 10 years. So this is the picture here. So US 10 years, we're at 181. We know that what the headline has to be for the next 3 months is on your Bloomberg, on everything. US 10 years is at 2%. It has to come. It will come. So that's probably the move. And what is interesting, going for the yield curve up the 10 years versus the 2. So that is the big move. So you see the flattening, what we call the flattening of the yield curve. So if you take the 10 versus the 2, it's going lower. It went by 10 to 15 bips over the last couple of days. Why? Because the US 2-year has been massively up. So this is the picture. We did from 1% to 1.2% on the 2 years. In other words, for the 10 versus the 2, when there is flattening and when there is inversion of the 10 versus the 2, that is a very good leading indicator. Okay, so this is when I build the 4x4, when I've done the research, the inversion of the yield curve is the best leading indicator for 6 to 12 months for calling the recession. So if you start to, so in other words, what the market is telling us is there is inflation. Okay, we know there is inflation. Only the Fed took 6 to 9 months to realize that there was inflation. There is inflation. Okay, so this is why yields now have to go higher. But on the other hand, if everything is flattening, that means not in 2022, but in 2023, we should not be expecting crazy economy, and maybe down the line, because there is always down the line anyhow, a recession. Okay, and probably not now. And if you are still at 70 bips on the 10 versus the 2, that means you still got an economy ongoing. But further down, that means at least that we are not as let's say, bullish on the US economy. The GDP growing from 2023 onwards. And that is a bit confirmed by the ISM manufacturing and the services, where you saw the top. You've seen that the flash PMI was at 50 or 51%, which, we know that you get the variant of the COVID that is not helping. But if you go from 56 to 50, there is some question mark as well on how the economies will be doing, and that's reflected in the 10 years versus the 2 years. Quickly, euro dollar, because I think this is a very important chart. So because I'm an old man, I'm always saying the same thing. So I've been saying in the 22 picture, and so the call is at 112.50 being long. I think the support should be holding, using a 109.5 as a stop loss. Euro dollar should help, but that's the picture that you have. So I want to believe that we're gonna have something like this. Okay, so now at the moment, the trade is roughly down 1%. It was, as I said before, up almost 2% three weeks ago. But I like those kind of return, the risk reward where max you're going to be losing 2 to 3%, and then the risk reward is 3 times probably of your downside. Coming back to your question, that was Martin on the DXY. So we had a big move recently. I mean, we had a big move today for the last 24 hours. Why? Because the Fed was pretty hawkish, as we're going to discuss. I want to think that as I am quite bullish the euro, I see limited downside for the euro by 2%. I think the same for the XY. But again, that is the beauty of market. I could be completely wrong, but I only get a 2% downside from here. We go back to those slides. Okay, if I manage to do it, always a transition. Fed meeting. So yesterday, Fed meeting. So what are the expectations? Because what matters is what is the market pricing in terms of Fed rate hikes. So here I'm using the CME website. I think this is something called, I don't remember the Fed prediction, but if you do on Google CME Fed rate probabilities, they will give you on Google, they will tell you where to go. And here, this is for the March, which is the next meeting. Thank you, James. You're my hero. So the countdown to FOMC. So there is 100% plus expectation that they're going to do 25 bips in March. Okay, so that's for the next meeting. And if you look at the longer picture, which is December 2022, so here this is the first one, here this is the second one, here this is the third one, and the fourth one, meaning that you're going to have 4 to 5 25 bips rate hike in 2022 that are priced at the moment. And as you know my style, I like to be looking at the euro dollar. If I look at the euro dollar, if I compare the euro dollar as of today versus March, I end up with 27 bips, telling me there is a 100% chance that we're going to be doing 25 bips. And if I compare today versus December 2022, I'm at 1.19%. So 1.19% divided by 0.25 means, almost 25 bips hike. So remember, 6 months ago was probably 2 rate hikes. 3 months ago, it was closer to 3. At the end of last year, it was 3 and 3 to 4. Now it's almost 5. So the Fed is going to be more, what we price is the Fed to be more active than we thought 6 months ago. Okay. And further down the line, that we are only expecting another 50 bips. So overall, if you think about the overall cycle, if you take this one, 99.75 minus the 98.98, that means we're going to be moving by 1.75% up in the next 12 months, 18 months. So this cycle of rates is 7 times, 25 bips, okay, which is usually what we should have. And if you think about the math, and if you think about macro 101, or economics 101, if you think that inflation is going to come back to 2% versus 1.75 to 2% yield, that makes sense. Okay, so pretty aggressive Fed for this year in terms of rate hike. What was interesting from the listening of Mr. Powell yesterday is actually for 6 to 9 months, they tell us, you know, from March last year to November last year, they say everything is transitory. It's fine, it's bottlenecks, is, you know, it's COVID, is whatever. And we knew that something was coming, and PC was way above the 2% target. CPI was way above the 2%. And because of the pressure from the Biden administration and, you know, people and everything and this real inflation, from November, the story coming from the Fed is, oh guys, we need to do something. We need to be much more proactive. So they have been very late in reacting in this inflation story. And if you think about it, if inflation is so high and the economy is doing so well, why yesterday they haven't done like 25 bips? I mean, why not? If the economy is so strong, if the job market is so strong, why not? So the Fed is very late. I don't think they have been communicating so well. If you look at this chart, so this is here, this is at 7 o'clock when we get the Fed decision in green, the FOMC decision. Then at 7:30, this is when Powell starts to talk. So when Powell starts to talk, you get the equity market, the S&P, that goes down by 100 points. So imagine that you are the CEO of a company and you get great results, everything, and you get your earnings call. And when you start your speech, then your stock is going down by 5%, 10%. And it's not happening only yesterday. Okay, so yesterday it happened both on the equity market. And if you look in the light blue, that's the euro, where you get the dollar strengthening. So all the assets went the same way. Okay, so in other words, the Fed, or let's say the market actors, listen to the Fed and say, okay, actually they are very hawkish, and it's even more hawkish than what they have been before. I don't think that they were that much hawkish more hawkish than usual, but that means now we are expecting the Fed to do something in terms of rate hikes, and as well to do some tapering ending at the end of March. And then, you know, probably September onwards, I mean, at least this is what they say for now, that we're going to be reducing the size of the balance sheet. So if you think about it, the size of the balance sheet now is 8 to 9 trillion. Went from 3 trillion to 9 trillion. And that means that we had tons of liquidity everywhere going into the system. So if you look at money M2, if you look at M1, if you think about the amount of money that went for the liquidity of the banks, we had a lot of liquidity. If you start to withdraw this liquidity, mechanically, that means the risky assets will have to come down. So the part that has been coming down, the risky part, extremely leveraged, no growth, has been suffering. But I think what is key now is for private equity. Okay, so private equity so far has been putting numbers on the books. Okay, so you've been saying, oh, this company is worth 20 billion, 30 billion. And suddenly they will have to change the price because, you know, the equity market is 10-15% lower. So 10-15%, a lot of private equity will have to mark down. That means a lot of assets will have to come down. So that means the wealth effect, which was on the way up, is now on the way down. And that means real estate could come down because, you know, if you don't price the deal at the same prices, that means California, all those real estate has to come down. That means as well that all this deal with the what's his name, this Japanese, I always forgot the name, but that means many deals will be doing, will have prices coming down a lot. But that is not new, okay? So this one I think is an interesting chart, which is SoftBank. Thank you, Anand. So SoftBank as well will have to put prices down. So if you look at the S&P intraday composite, by Fed chairman, you can see in red, so that is for Mr. Powell here, how badly each time he's talking, the market is reacting. So on one hand, I think so far, last meeting, he was okay. I think that his talk was pretty good. The ones before were just disastrous. But that tells you that at least the market is very, let's say, not at ease when the Fed Powell is talking, which is not a great thing if you think that the guy is running an 8 to 9 trillion book. that is a bit of a problem. So let's jump into the sell-off. So this one is from Eric Balchunas on Twitter. You should be following him if you're not. So he's let's move a bit this. So he's doing mostly ETF for Bloomberg. So this is the turnover that we had last Monday. Okay, so that is the turnover for the S&P and for the QQQ. So again, we know how the market started over the last 3 months, selling off of the high growth revenue, crazy multiples, no earnings since that time. And many stocks in that universe, if you do the screenings, have been down between 30 to 70%. Okay. Last Monday, again, we saw huge volume. We get the retail traders who sold off their position at the start of the day. I think it was mostly through options, because they are not through options, but because they were assigned options. They were long the stocks, or as they were long, they had too much and not enough capital on their bank account, so they had to close some of the position. Then at the end of the day, when the market started to squeeze with the delta, with the gamma, everyone had to chase up, and we had this huge rally. Okay, but the assumption, it's not only the assumption, the reality is we are running a negative gamma in the market. So it's not huge, but still we are running, and that means each time the market starts to sell off, there is some acceleration. The only thing that is good so far is CTAs, which are running quant system very shortly, are neutral the market for the time being. So they are not long or short. But if you look at the day, like Monday, we had 170 billion combined. So if you look at this chart here on the turnover, so here this is for the S&P, the SPY, we had 107 billion, which is almost the level that we had when we had huge pressure in March last year. So that tells you how big the activity has been since Friday and Monday with options. So it's not like a sell-off that is done in small volume. There is a lot of people involved. There is a lot of turnover from the books. Same with the for the QQQ. So the QQQ all-time ever in terms of notional that has been traded. You see this amount. I mean, it's just huge. And that is true as well for some stocks and from ARK, for instance. So what is the sell-off in terms of market breadth, or the internals of the market, something that I like to always look at. So here I'm using something a bit new that I've been using so far, is looking at the S&P 500 components and looking at how many percentage of those members have been trading above the 50-day moving average. Stuart, where can I find market gamma? Where can you find market gamma? There are some guys that will always give you on Twitter the market gamma. If you send me an email, Stuart, I will give you the Twitter account. I don't have an answer right now, but I will give it to you definitely. Coming back on this percentage of members with above 50 days, you can see that we are putting aside this March 2020 sell-off. We are pretty low. We are only 30% of the stocks in the S&P are trading above the 50 days moving averages. If you look at the Nasdaq, you don't do technical analysis on this. You just try to think about, what are the odds, what kind of are we up in the percentile, or are we low in the percentile? Here we are 16%. So very few stocks have, let's say, a strong price action in the short term, okay, in the short run. 50 days moving average means roughly 2 to 3 months. And again, only 16% of the stocks of the NASDAQ are trading above this level. What about the Russell 2000? This is the same. Russell 2000, 16%. So that is as well one of the positive of the sell-off is many stocks have been absolutely hammered. A positive, I think, is the positioning and the market feeling is very negative. So we went from a month ago, everyone was bullish, 4750, 4800, we're going to go to 5000, where now it's the end of the world. So position is not yet extreme, but you're getting closed on many indicators being close to at least an internal a potential low. Sell-off, let's carry on. So why I want to put this CBOE 2022 option expiration. So we are in 2022. This is the first webinar that I do for the Market Thursday. And you know how now those options, how important those options are. So put in, if you decide this year to trade the market or to have a portfolio, you put in your calendar all of those red dots and say, this is the time where the market could change the price action. You can do that in red for the S&P mostly, or for the options, but do as well for the VIX expiry. And this is really important because again, the market is mostly driven by options. So that will dictate a lot if we carry on with the sell-off or if we bounce quickly. Seasonality, I like seasonality. I like seasonality because that tells you how investors have been doing things for quite a long time. January, February are generally bad months in terms of returns. So if you look since that, again, anything that I'm mentioning here, it's not because something happened in the past that it's going to happen again. It's just you need to think about the odds and market behavior. In January and February, most of the time, on average for the last 20 years, market has been flat to small down. Okay, so those are the numbers, and literally normally it's very tilted to H2 and better in Q2. So don't be surprised to see January and February as a bit of a struggle. Go on equityclock.com to get this chart. This is quite helpful because that tells you that this part Q1 is very often flattish, and then you could have room. That doesn't mean that it's going to be the same this year. And don't come to me in 6 months and say, look, Greg, you're saying I should go long from April onwards. That's not what I'm saying. What I'm saying is, if you look over the last 20 years, this is what has been happening. And I know retail traders, they will pick something and say, oh, Greg said this and Greg said that and etc. We all try to find, some pattern. You all try to find, some explanation. This is one of them. Looking at seasonality is helpful. With seasonality, there is something that comes, which is the midterm election year. The equity market around the world is driven by the US. It took me some time to realize that, when I started trading Europe, probably took me 2 days to realize that no matter what Europe was doing, it was about following the US. And what is important in the US this year is you get the midterm election. Okay, midterm election at the end of the year. But midterm election means obviously there is politics, and when there is politics, there is always there's budgets, but overall, what you should, again, similar to seasonality, have from the previous midterm election, there is a high probability that the average S&P will fall by 16%. So this one is from Bank of America. You get the stats. So if you're on YouTube and you're watching it, take the time, click on pause. Otherwise, guys, the one that we're watching tonight, maybe watch it later on YouTube, or actually it's on the community. For those of you who have access to the community, look at those things. You can see that it is normal in a midterm election year to have quite a significant drawdown. Okay, so if you think there are some years like what was it, 2017 or 2016, where the drawdowns were very insignificant, less than 5%. If you look since 1930, drawdown is something like 20%, 16% on average. So far this year, we are down 10%. It is normal to have those things. Going into the next slide, and I think this next slide is even more telling. So on the left-hand side, you get the intra-year decline on the midterm election and the year after. So in other words, if you look at this table, I think we should really ask ourselves, if you are running a long-only book and you are not running a long-only book, if you are watching me, or if you're doing like me, or if you've done the 4x4, because you do long short, but if you are a long-only product, should we come back in a year time? Because that part is telling us it will come down, and it is coming down, and this part will tell us that in 2023, normally after this midterm election, is a good year. Again, this is stats from the last 70 years. That doesn't mean that it's going to happen again, but playing with the odds is always better than going against the odds. Next one, earnings season, and we're going to finish on that because I think earnings season is the most important thing. We can be doing a lot of talking, but at the end of the year, at the end of the day, what we use for the S&P, for the NASDAQ, is we take the level of earnings and we multiply by X, and that gives us the price of the S&P of the NASDAQ. So if we take the S&P, if you say that this year, 2021, or last year, 2021, we got $200 for the S&P, and we use a multiple of 22, that gives you 4,400. If you think that the earnings of the S&P are going to go from 200 to 220 or 230, and you use a multiple of 20, that gives you 4,400 or 4,600. Okay, so what is the earnings season? How the earnings season has been so far? So here, this is only for 100 companies. So that was yesterday. I've done it yesterday. So that's 1/5 of the S&P so far. Out of these companies, 67% of those companies have been beating sales, which is exactly the same as last quarter. And for the earnings, it's a bit below, 80% in terms of 82. So in other words, if you come and you read some paper and saying, oh, look, this earnings season has been absolutely disgusting, it's horrible, this is why the market is down 10-15%. That is just not true, okay? The earnings are very much the same, almost like they were last quarter. Probably the beat are not as good as before, okay? So what we used to have over the last 4 earnings season is tons of beats, like 80-90%, and way above. Whereas these days, the beats are not that way above the expectations. And as well as there is not that much visibility, that puts into question the Q1 of 2022. So it's of 2022. So it's not only what is happening now, but obviously what is happening in the next few quarters. So very often you see meeting expectations. So you see the first headline and you say, oh yeah, great, this is great. And then you look at the expectations or the next 1 to 2 quarters from this company, and you can see that the numbers are not great. I'm thinking about, Netflix is an example, but there are other stocks that came with not that great numbers for Q1 or Q2, and that means many stocks had a very poor reaction on the earnings day. So I just did this quick research looking at the stocks that released their numbers, the companies that released their earnings so far. On average, the move on the day was minus 1.5%, and they underperformed the market by 1%. Okay, and you can see, so if you take here as the 0%, I mean, yes, we have been in a market coming down, so obviously this is distorting everything. So that should have been against the S&P or the relative performance versus the S&P. But you can see the size of it versus the small. So that's the negative, that's the positive. So there is a massive skew towards negative reaction. And actually, that was the same. The previous quarter, it was not necessarily on the way down, but you remember previous quarter, all the stocks beat, the realized volatility on the day of the earnings was much, much higher than the implied volatility. So that means if you were long straddle on the day of the earnings during the last earnings season, you would have made a ton, okay? And this one is very similar. So where realized volatility on the day is much higher than the implied volatility. As the market is coming down, there is literally a skew to the downside. So this one is telling something that you can be using if you don't, if you have position or if you're trading more actively. So here, this is on FinViz. So FinViz, if you're familiar with it. So they have tons of ways of doing some filtering. So here I use the above 2 billion market cap, and I looked at how the price action was for stocks that came with the earnings on the day. So that was as of yesterday. And you can see here, most of the stocks were down on the day. So price action so far, okay, we are only 2 weeks into the earnings season, but so far reactions of stocks on the earnings has been pretty bad. Not because of the earnings of Q4 2021 were bad, but I think mostly because the outlook for the next quarter very often has not been that great, and as well because the beats were not as big as they used to be over the last 4 to 5 quarters. So in other words, if you are position, long position, you should be, you could expect the stock to move quite a lot. So there is a skew on the downside these days. So be very aware. It moves a lot. Don't be a superhero. There is absolutely no point, because I think these days the moves on the earnings have been absolutely brutal. Brutal in the sense that stocks are moving 20–30% and there is no escape. Okay, so what I do for the newcomers tonight and for the people on YouTube later, I do 3 things. I do the trading community. So I'm more and more involved with the trading community. So I'm going to be spending a lot of time with the trading community this year. I try to put a lot of content. There are more and more of the traders that are putting content. So thank you to them. We are building something that's interesting, that hopefully is going to make us money this year. Second thing that I offer is the 4x4 videos series. So that's an investment process based on my 20 years experience in the industry, long, short, classic asset management, hedge fund, prop trading, and as well from being a mentor and an educator for the last 6–7 years. I've seen other products. I can tell you the stuff that are not working. I can tell you why people have been struggling and why people have decided to do the 4x4. And finally, I do some mentoring. So this is online mentoring, Skype or Zoom, where I help you getting the investment process and building your portfolio. So books usually will be between $10,000 to $25,000 to $200 million. I've been helping 100 traders, doing mentoring for 100 traders since I started in 2014. So if you're interested, what you do is you contact me on the website, on Twitter. You can send me an email. If you like what I do, if you like this video, put a comment, do a like. This is quite helpful for getting the momentum from the Google of this world. Other than that, I try again to change the format of this webinar. I'm not sure what to do exactly. I think the version is too long. I'm a bit frustrated. So if you get some good ideas, I would like to do more something, 20, 25 minutes, maybe instead of every 2 weeks is twice a week, going through questions, those kind of things. So always trying to improve the product, be safe, tough market. It's a brutal market. It's a hit and run market. It's a trader market. Enjoy and talk to you soon. Good night. The market is at 43.18 on the close for the S&P. Interesting going forward. Thank you, all of you. Bye-bye.